So
what do you do about unorganized sectors? Because the whole market seems to be evolving and it seems to be unorganized coming. So somebody was telling me the auto exchange thing, right? In Chennai alone, 1.5 crores of money passes through in auto transfers.
Correct. Exactly. So let's look at that. You can't create the money. Money has to shift. You can't print money overnight. Money has to shift from somewhere else to some newer direction. So market, your understanding is like taking the auto. At the end of the day, because you do it, you may make them more efficient and get more money out of the system. But your initial transactions is that whatever 1.4 crore is the target market. What percentage of that? Can I create a 10 lakh business out of 1.4? Looks reasonable. But if you have a 1.4 crore, can I get 1 crore out of it? It looks hard. But if the 1.4 crore was 100 crores, can I create a 5 crore business? Looks easier. So bigger the market, whichever way, organized, unorganized, we get into some of those categories of organized, unorganized, how do we get it? But bigger the market, chances of your success is high. Smaller the market, then you have to be the de facto dominating player in that market, removing oxygen for everybody else. We'll talk about that. To get to 200 million, there was a question about revenues. How much should be the revenue of a company? This is again forecasting in 5-6 years from now, what should be the revenue? You don't have to have revenues. If you have massive usage, like 30%, 20 to 30% of India is on your platform. Daily and weekly interaction units are very high. People are, using it, and it's growing like weeds. People are bringing them and just going through the roof, and you may have very little revenue or no revenue. Doesn't matter. Chances of you exiting beyond $200 million plus is there, because as long as there is a potential of revenue models, if you are executing like this, people are willing to put a lot of money. Even today, I don't know whether many of you know, Quicker and OLX, both of them are not making a lot of money, but so much of interest from investors because both of them are becoming and trying to take on the classified space in India, one of the key positions. Example, WhatsApp, So here, it doesn't have to be revenue based, but you have to have a usage, traction. And it can't be fading. You come 2 months, they use like a game and go. It has to be consistently sustaining long term. Second is, you can get with deep IP and technology, which means you may have few anchor customers, but you have a lot of patents on the IP, and IP is pretty much global appeal. It is at the heart of it. It's not an application layer IP. It's at the heart of the technology. You saw that the cloud.com didn't have a lot of revenue, but the exit was $200 million plus, which is a US-India play. That happened. So it is possible to have exits with a deep IP and deep technology company. Not a lot of them I see in India, but quite a lot of them in Valley and rest of the world. But we are starting to see in healthcare, med devices, med technology. We have, you look at like, if you create a molecule, and that could be a $5 billion potential outcome, somebody will pay 200 million, some of the big pharma companies. Or you find a cure for cancer, whatever it is. So that deep IP tech is possible. You don't have to have revenues. 20 million plus revenue. What kind of company? Applications, enterprise apps. Could be online, offline businesses. You have an online on one side disrupting an offline, like what Redbus did or Taxi for Sure doing and whatever those. You have to have good operating margins. Profitability has to be there. We have to see that unit economics getting there at 20 million plus, and you have to be growing fast, 30% plus per year. So this kind of things also, getting a 10x in India is possible today, predominantly because there is not a lot of companies at 20 million plus revenue. There is so much dearth and demand for this kind of companies. Anybody getting there, you will be the hero. 40 plus, if it's a non-subscription business, which means one-time sales. You have a large field sales force. You have to get the customer again and again and again. There's a product, a lot of services, maybe 40% of your money is services, 60% product, maybe 5 times you can get it. And the margins are lower because most of the money is going towards your sales, pilots, and and getting it, and a lot of pressure from customers on your pricing. You have to get to 100 million plus revenue if you are doing in e-commerce. More than 2x is very hard to get because it's a very, very low margin business. Or you have a niche service provider, like another outsourced software company or another one, at least you have to get to 100 million plus revenue to get a 200 million plus, 2 times, maybe 2.5 times. Just have a margin here, the gross margin, Google is at 65%. Most of the SaaS companies are 70% plus. So cloud-based enterprise SaaS companies are doing well, equivalent to Google. Operating margin for Google is 25%, whereas Amazon is 1.8%. So you can understand the gap, so where e-commerce versus platform-based games. So this is for the.
So what would be the gross margin in something like ticketing and all those things? Clear trip, make my trip.
So ticketing, let's look at it. Usually 15%. If it is a 500 rupee taxi booking, you get 15%. So 15% of like a 75 rupees. In 75 rupees is your revenue. You have to connect the call center. You have to make sure taxi goes there. You have to make sure everybody is operationally efficient.
Pay yourself.
And pay yourself. So which means by city to be profitable, it takes a lot of effort. Same with the ticketing is much lower. Make my trips and all is margins are very lower. Yeah, sub 10%. So here's another question: how much should I raise? So anchoring again around 200 million plus. Take that as an example. If you have at $100 million plus exit, I will take it today, anytime. So typically $25 million is what get raised to get to a 200 million plus exit. At least our intention is that you take around 6 years to get to a $200 million exit. To raise 25 million, you need at least 3 investors. Okay, so 3 investors, maybe some angels there. You raise 25 million plus. Initially it took some time, but in 6 years you get the exit. So basically 8x of the invested dollars. $25 million got in and $200 million came out. But just wanted to let you know the US average is 4.7 times. US average in 2012 was 4.7 times, which means they have raised 50 million to get to a $230 million. That's where they are. Time impact, revenue. Now, first 18 to 24 months, you will be there between 0 and 1 million, 24 months. Then 2.5, 8, 20 plus, you start seeing this hockey stick slightly later. So that is a non-linear growth we want to see, like, which business should support, where we can raise money. And distribution. If founders work, if they can keep 20 to 30% for them at the end of the journey, that is 60 million for them. 5 to 10% for angels, 20 million. 55 to 75% among 3 investors. So each investor is at 40, but it varies a little bit there because first investor may have less, last investor may have more depending on the equity, but averaging out. At 200 million, if everybody gets out with this outcome, that's fantastic. That's what an ideal situation is. But what's the reality? 6 years. Very, very few companies in India are able to build business in 6 years. It usually takes 10 plus years. In fact, look at the Make My Trip or Just Dial before they going public. Both of them took more than 10 years. It is possible now with more internet penetration, more mobile, it's possible to get there, but time is taking longer. Because time it takes longer, you need to raise more money. 25 million may not be sufficient. You have to raise 30, 40, 50. Because you have to raise 30, 40, 50 million, 3 investors are not sufficient. You may have to go for 4 and 5 because everybody wants to follow up, everybody. So what happens is, if it takes longer, you raise more money and more investors, chances that the founders' equity starts coming down. And after all these efforts, founders taking out money is lesser than the investors. That's not a healthy ecosystem. You want founders to take more. And how do we do that? You do it fast, do it efficiently, raise less. If you raise more, exit less, then it's in trouble. And 200 million plus remains 200 million, by the way, after 10 years too. So, market. Any questions from you so far that where you believe? One of your experience dealing with a lot of early stage companies.
So one of the questions, I have 2 questions for you. One, people are basically saying when you're actually trying to fundraise, it's important to know how much you will raise, right? Yeah. Over a lifetime of the company. Correct. Because equity structure depends on that. Yeah. Today, I think entrepreneurs are trying to optimize on the highest valuation early on. What is your take on that?
See, so far out of the 50 companies, I think I can't even put a finger on one company that has gone as per the plan. They have pivoted so many times. Every one of our companies. Mintra right now is in the 4th iteration.
Your life sounds very exciting.
Huh?
Your life sounds very exciting.
So it's actually fun. So, because every time we meet the company, they have a new story, how they're going to build the business after taking the money. So the pivots happen. So it doesn't matter. The only for me, India, where we are today, the maturity level is so low. There are only 2 outcomes: win or lose. That's all. Don't worry about who gets what, optimizing that. Are you going to win or lose? What's your definition of win? For me, the win definition is if I join Wipro, Infosys, TCS and become a senior vice president, made some money. As an entrepreneur journey, did you beat the crap out of that and say, got 10x of that? That's a win for me. Yeah. Or you work for 3 years in another company and made some 15 lakhs per year, but you got an exit of 5 crores. That's a win for me. So win and lose, there are only 2 outcomes. Lose means you abandon the journey and back to the basics on something else. Win, you got an exit, plain and simple, and you return some money at least. If you can return the money to the investors what they paid, already a win case for me.
I can already see your pressure. so second question, right? So a lot of people, right, for example, people are basically saying there is a very similar company like mine sitting in the US who raised $5 million, but you're only writing me a check for $1 million, right? Or if I say that I want 5 million, you're basically saying I want slightly more equity because clearly it seems like the company is going to take longer. Is there an opportunity where entrepreneurs should basically say, even if I dilute a little bit more, if I hit that 20 million, because you're saying if I hit 20 million, VCs will listen to any term sheet that I give them?
Absolutely. In fact, there are 5 companies today where every VC is chasing, they're not taking money in India. There are 5 companies where one full-time associate chasing these companies. And we are influencing through their parents. Still not still they're not taking money. It is possible in India, sitting in India. Obviously, everybody knows about Zoho, right? Everybody on earth, including Axel US, wanted to invest. Like those, there are hidden gems in India. Most likely, you don't see them in the hallway here because they're hunkered down building their next business. So, but I'm saying there are companies there. So it is possible to build. The question from you is, if I'm going after the customer base in Valley, but sitting here and they've raised 5 million, it's not even, you already lost the game. What is the edge you will have to win against them? You need to have a differentiation from India. Otherwise, it's almost impossible to compete and win.
So what is your story for Freshdesk?
The Freshdesk case, can I take that? I'll give you the example of why Freshdesk invests. Well, just 2 minutes on that. So Freshdesk is going against the global players. Surprisingly, in the customer care.
And they've raised, Zendesk has raised more money.
Zendesk has raised 50 million plus. Already $1 billion plus value, may go IPO. So Freshdesk case, if you look at the customer care community, one of the toughest to sell, because they don't buy just because they like the website. They will evaluate a product for 3 months or 2 months before they make a decision to buy. That is the mentality of a customer care team, because they have to live with the product for the rest of their life for 5 years answering questions. So there is a lot of trial. So the question really is, can I build a better product? And when they found the gaps in Zendesk's, I guess, product portfolio, Freshdesk team told me that they can build a better product. So our decision to invest in Freshdesk was predominantly, market is big, everybody knows. You can compete globally building a better product. Because of the history of working in Zoho and creating one of the better products, we said that's the bet. And it's actually working. They're doing very well and they're scaling, and quite a lot of Zendesk customers are shifting in their favor. All from Chennai.
So I have one last question. So somebody was basically saying, if you had to build a SaaS company in the US, it costs about $40 million over a period of life, right? So you said 25, so that's slightly higher than that.
Yeah.
How do I know what these numbers are?
Yeah,
because
so
a lot of these entrepreneurs...
One third, you can build within 15 million. If you are efficient in sales model, online sales model, you can build a SaaS company within $15 million. You don't have to be 125. In fact, in the case of Freshdesk, they're almost breaking even.
200 million valuation.
They're almost getting break even. The money they're raising is to go fast.
Good.
Okay, Fundable teams. There are 2 parts. You see a lot of teams. When to take the first one, I will talk the second one.
So So what we essentially want to talk about is two teams that is coming up, right? So okay, let me just figure out. So this is the average, and a good chunk. Actually, this is a much more mature audience, but a good chunk of the entrepreneurs that we talk to usually fit this profile, right? So most of them are roughly around the 26 to less than 30 years age. Probably did not take a job yet, or probably has been about 3 years. So the average we've been looking at is about 3 years. Most people go for their appraisal and basically say, you know what, the ladder seems very steep from here. I was hired in a lorry with 12,000 people. Kind of looks like it's going to go from 12,000 to 500, and that ladder doesn't seem to be making sense. So they quit and say, you know what, if I've been working for a company and making money, why don't I basically start up, right? Most of them have been individual contributors, right? So they haven't really quite worked together as a team. I don't think the Indian company ecosystem really has built into separate teams, basically going out and building a product, launching something, taking on the market. That doesn't really happen. That's the reason why, you know, companies like Zoho, companies like Bosch, companies like people who've been working in Amazon, right? They make great entrepreneurs. So a little bit of the history also helps. Extremely passionate. I don't think anybody in this room I have to explain what this means, right? A good chunk of them really don't understand minimal go-to-market strategies. So G2M is go-to-market strategies, right? So because we actually work in quite a few cities, one of the things that I notice is that depending on which city the entrepreneur is coming from and which company he works for. So they might be working for a Google, which basically is saying that, you know what, hey, we're going to build the back-end technology here. Phenomenal back-end technology getting built, but then, you know, like, how do you take this to market? They're like, quite honestly, we have no idea, right? So they don't really know how to go about it. So the one of the side effects of an entrepreneur backing an entrepreneur like this is that every time they go to the market and the market says that this is not a right solution for us, they come back and build another feature, right? So here's the competitor basically having 5 awesome features which is selling, and you have 50 features but you're still not selling, right? Features don't really make the difference. You have to kind of figure out pain point, address the problem, pain point, address the problem, right? So if that connection is not happening, you're not going too far. Most of the ideas are coming from their world, right? So when we do in 50 hours and things like that, we do realize that a good chunk of people are basically coming back and saying that, you know what, I'm getting, you know, pretty much flooded by stuff that is going on my Twitter feed. I want to basically build a personalized message. Is that really the biggest problem in the world today? It's not. As Indians, if we look around, we probably realize there are a billion problems around us. But it's nothing wrong, right? Because the number one way of people building ideas and companies has always been solve a problem for yourself. And quite honestly, they're solving it for themselves, right? They probably have a family support. You know, the parents are probably taking care of running the household. So, you know, somebody was basically doing this talk, the previous talk, somebody said, in India, we don't really stand in long lines. We stand in long lines all the time, right? Electricity bill payments, you know, water, power, you know, we're just sick and tired of standing in lines, and we don't want to stand in lines for Apple iPhones also, right? But most of the ideas are coming from their world, right? They don't have a product experience. A lot of them actually have bursts of energy that actually come in. They will come up with an idea, but they don't know how to take that idea all the way to the market, right? And that's what a product means. The definition of a product is taking an idea, a pain point, and finally reaching it to the customer, coming back and iterating it 2-3 times. That's when you have a product. Until then, you only have an idea, right? So clearly, this depends on a lot of cases. In some of the cities, the business part actually supersedes anything, right? You go to a Delhi, you know, they'll basically start doing revenue plan before even having a product, right? They're like, everything else we'll figure out. There's nothing wrong with that. That's brilliant, right? You come to Bangalore, they're probably going to build, like, you know, I need to do the system architecture diagram before I talk about business at all. I think the optimal path is somewhere halfway. It's really not here, really not there. But we're talking about real business here. We're not talking about holding an MBA degree. We're not really, because early on, I think you have to be an entrepreneur. Second, you have to become a business guy, right? So when you're scaling up the business, you're still saying that I'm going to do things ad hoc and experiment and things like that. All the people that you hired are going to run away. Right? So you have to basically turn into a business guy at some point. But we are not seeing a lot of people coming from either running businesses themselves or coming from a business family themselves, right? So one of the things I was telling Shekhar was that we were actually having this very honest conversation with a bunch of VCs, and they were basically saying, here is a team which is coming and asking for $5 million. They have never handled a budget of $100,000 in their lives before, right? Even in the safety of a separate company. Right? Nobody has trusted you with $100,000. They are coming and basically saying, give me $5 million that I can run at my own discretion, right? So you can understand why some people are a little, hesitant about it. Most of them are great in tech, right? A good chance. I mean, this audience, it will fly. If I go to CII and say this, they'll kick me.
The question to you then is,
Oh,
what percentage of people, I'm not asking some questions, man, you're asking me now. What percentage of people you see in your 50-hour startup and various in Chennai and all your activities kind of fall in this category?
Probably about 90%.
90%. So 90% of them, you're advising them, and that's where actually we spend a lot of time. What do we say to them? Because mine is 95%. We see around 1,500 teams per year. Probably we fund 10. So our CTR rate is very low, just FYI. So, what do we do? Because they are extremely passionate people, lot of interest to solve the problem, and they're in the ecosystem, and we want them to be successful. So here is my thought. Give me advice on whether you think it works. I say, whatever your idea is, create it. Launch. Launch is the most important feature. That's what people say. Just launch. Get the product out in the market. Do some homework. If some people say yes, get the product out. Since most of them don't come from sales marketing, you learn a sales marketing product hiring on your product, on the field. Get to hear to the customer, what is the product. You have to make choices. The number one thing we are looking for is, are the persons have made tough choices. Should I hire an engineer or a sales guy? That's the number one constant question an entrepreneur has even after taking money. Those decisions, they should have made at least 300 such complex decisions in their life so that they know how to make those decisions. Maybe they're wrong decisions, but they should know the outcome of it. How do you do that? Only you have to get in the field and do it. Just do the marketing. If you're an app you have built on the iPhone or an Android, see how do you get more uploads or more downloads happening. That's plain and simple. Do all guerrilla marketing tactics. But pay self. Don't try to say that, I will do it without money. Try to figure out way to extract money.
And don't swipe your credit card.
Yeah, don't swipe. Just see whether you can get yourself self-sufficient. In fact, about 3 weeks back, I saw a company, one member company. He has built the website. He is the customer care. He is the support guy. And he is making more money himself than what he would have made. And he is dropped out of school 1 year. I think that's why he did all the things. Then went back and finished, but started this company when his final year. So he's already at this 26 is like a 24. He doesn't know whom to hire next now. That's where he is. But he's making money enough to pay for himself. Fantastic. Talk to as many your customers, users, mentors, investors, these events, wherever it is, learn. It's important to learn how to play the game. Because you're building skills before you are ready, and I want you to, as many of you, build those skills. And in the path, you see a big opportunity, then go and race. And that usually happens. Many people discover that, I'm trying to solve this problem, but I see that there is much more unique usage people are asking me to do. And you pivot it and you say that now I think looks like a big opportunity, I'll go and race. So at the end of the day, we want people to do, and we are really big on serial entrepreneurs. Somebody who has done a second-time entrepreneur, even a failed first-time entrepreneur has got a lot more value for us than a fresh entrepreneur. Experiment and learn, basically iterate faster. You have to survive, you generate revenues, and if possible, actually do an exit. Love to see a company which has said that I sold my first company for 50 lakhs. Great, because they would have understood the exit process also. And get deeper insights and domain experience. And we have seen that the second-time entrepreneurs in the area come back with a lot superior value. Okay, so what does outstanding team mean in our world? Usually it is 2 co-founders. Very rarely one co-founder has worked for us, but 2 co-founders is a perfect example. They have a street credibility. Somebody says, CTO of Make My Trip and VP of sales at Just Dial. They have come together and want to start a company.
Or even somebody saying that, hey, here's the guy who actually built a game engine over a weekend.
Or demonstrated success. So street credibility means that. some sort of an operational background. They've done something interesting, they've raised money before, or they've built a sizable business in their existing business, or they've hired 100 people and shown how to scale and managed large budgets. Some go-to-market experience in the area where the company idea is going. If it is digital, they need to do digital marketing very well. Some domain experience and deep product experience. This is where, again, if you're going for a product-oriented company, the deep product experience is very critical. And passion and commitment. This usually comes up if they're left their full-paying job to come out and do it. There's always a passion and commitment to do that. That's what drives it. And ability to make decisions fast, and ability to do experiments, because that's the only way we learn in the new world, even outside the existing infrastructure of their old companies. So these kind of the characteristics makes a good team. But the number one killer, usually for a startup for us, is sometimes they don't know how to work together. And quite a lot of startups fail because entrepreneurs don't know and don't work together for long enough time. And we see that more often. So whenever we see that, hey, I met my co-founder at NPC 13 and we just started a company and I know him very little, I've never met his house or wife, tough. Pay me $5 million.
Would you back a husband-wife team?
Good question. We have at least three husband-wife teams in the company. But of course, we would like to see them work together, not married now and giving money. That is like the system has not gone through the enough ups and downs. We have to see enough ups and downs so that we can bet on them. And that is working out very well actually. It's like productivity through the roof. Okay, I think we're running out of time. Let's quickly run through and then we'll get questions. Okay. So which are the markets are kind of VC friendly? Network based. People love network based. If you get one customer, they bring other customers. It grows like what happened at Instagram, WhatsApp, or even LinkedIn. Those kind of things. Network based. People love those. If you get traction there, that's a good place to be. Marketplaces. Again, it's a hard one. No traditional business people will solve this. Marketplaces are tough to crack. Usually use technology. It's a double-sided network problem. Very hard, but if you win, winner takes all here. So this is also very interesting ones. Common Floor is attempting in our portfolio. 99 Design is for logo design. I don't know how many of you know. Odesk is for outsourced work, for sub $2,000 kind of work. So these kind of marketplaces work very well. New markets in creation. This is also a very interesting area. Basically, you see that the market is being created because of a new technology, new platform, or a new habit people are starting to see. And when that happens, you can go after it. Because I'm seeing that in India with WhatsApp, more people are interested in messaging than talking. So I'm starting to see companies saying that I will do customer care over WhatsApp. That's an interesting idea. They're hijacking the new habit. So that is the new markets in creation. Shifting money. This is the age-old idea. A lot of companies have done well. Usually first mover advantage is there. Like Book My Show. Tickets are being bought. I think 3 billion tickets are bought today in India. Why not online tickets, right? Plain and simple. That is like I'm shifting money from what people are buying to an online world. Or what Redbus did. People are going in the buses, whether Redbus is there or not. Somebody will do it. Why not Redbus? Efficiency play. This is where platforms, technologies, enterprise apps, we're going and say, I'm going to save money for you. Very hard to do it, which means because the enterprises are very lethargic to change. So you need to have extraordinary value creation, or they're in the shifting cycle. When enterprises are shifting from one model to other model, if you can play there, that's fantastic. And exit friendly. This we are seeing, there are some old, not social, not modern technology. There are companies or markets that are really old, big players, billion-dollar companies, very slow to move. You create something unique there, very easy to exit. Quite a lot of there, like healthcare is in that category. Even payments, in US, you look at number of payment companies, large payment companies, very slow to move. You build something interesting, people buy. So I'll quickly run business constructs and then take a few questions. So what's the preferred version, license or subscription? What do you guys think? Subscription, good. In fact, I would say, if you can get, say, if a customer is willing to pay $15,000 one time, and you can convert into a $7,000 annual, or pick that $7,000 annual, as long as you know how to collect that money.
So, quickly, right? So, as an early stage of a company, let's say that I'm actually building software for very specialized R&D departments, and somebody is willing to pay me a 40 lakh license fee.
What do you do?
And yeah, I know that over a period of time, my brand will be big enough that I can do SaaS. But early on,
first 50 customers, if we can collect enough money, they don't need us. Collect enough money.
We're both out of a job.
Both out of a job. Actually, a lot of companies have done that, where they have. But what happens is the DNA sets in. It's like, getting used to this 40 lakhs upfront, and that's a slippery slope. It's very, very hard to come out. Because, every now and then I get a pitch saying that I'm a services company, I'll build a product. My services company pays for the product. Very, very, maybe two. In my example, I've seen that they've transitioned out. In-prem versus cloud, obviously love to hear cloud versus in-prem, but there is a room for in-prem, maybe outside we can talk. If you're offering a product on the revenue side of the equation or on the cost side, and if you're on the revenue side, almost always, you always win. For example, revenue side, you're offering a portal for people to get a job, that's on the revenue side. You go to an enterprise and say, I will save your QA time from 3 hours to 1 hour. That's on the cost side. So revenue side always wins. People are willing to spend more money. Revenue flow. This is very important in India. Start versus end. Does the revenue first come to you and then to rest of the world? Or revenue flows through everybody else via revenue share and finally comes to you after 9 months? Start. Especially in the mobile ecosystem. By the time you see your money is 9 months. Or from large enterprises, they say they'll pay you, they'll never pay you. So that's the key issue. But in a global setting, it's okay to be in the end, but because contractually you can force it. Single versus multi-tenant, if you're doing a SaaS kind of a play, always multi-tenant type of product. Same product being sold to multiple people is better rather than a single instance. Inbound versus outbound. Inbound sales for me is sales are coming through the calls to you or through request, which means you are spending more money in marketing to generate leads to you. Is a more efficient model than picking up the phone and calling. There is a room for outbound calls, but if you can crack inbound sales, then it is more a spreadsheet driven business. You can raise more money translating into more business. Inside sales versus field sales. If you're in India, global markets, I prefer inside sales versus field sales because ability to manage field sales is harder, revenue per customer has to be higher. If we can do inside sales is far superior. India versus global, what's the pick? Global. Because unless you're doing first order business in India, like taxi, like gold, you're saying, I will build a product that makes e-commerce companies efficient. E-commerce company total business in India is $1.5 billion today. It's growing. That's the size of the business. You can't get to this $200 million exit solving for them unless they become a $50 billion company or total market, say in 10 years, which is very, very difficult. So that's the reason if your product has got global appeal, I would take a global appealing product or an India, Southeast Asia corridor product with purely India. So I'm already up by 2 minutes. There was one slide on investors. Should we stop and take few questions? What do you guys want?
So, I think one of the things that we all realize is that, so ton of people actually write to investors, right? Meeting investors today is not really that hard. People come to us and basically say, can you make an introduction to a VC? If you go to the 54, 55 top VC firms in India today and basically look at their website, they have an email address. But we wanted to quickly run through, it's not a long and exhaustive list, but a quick thing of what you should do, right? First of all, target the right firm. What Shekhar was also mentioning is that, for example, if I really want to start a chain of hospitals, there are people who are basically, it's heavy, capital heavy, right? But if you go to a VC firm and basically say, give me about $20 million so that I can set up a hospital, most probably, most of the VC firms are going to say no. But there are specialized firms that are set up saying that our only business is to set up hospitals, right? So you have to do your homework to figure out, hey, this is a company which actually has invested in the space. This is a company which is not investing in that space, right? So today, if you basically, and I think in the next 2 days, one of the things you'll realize is that the audience is going to be very split, and the speakers are going to be very clear on. Some will say e-commerce is a no-no. There will be some say that e-commerce is still a booming space to be, right? So if you send your pitch deck to somebody who says e-commerce is a no, you know what's the answer that you're going to get, right? So saving frustration from both sides, figure out whom you're writing to. That makes a lot of sense, right? Second thing, and this is also something Shekhar said, and I agree with. Do not write to everybody on a CC list saying we're looking for 5 lakhs of funding. Right? This sometimes happens with people in one firm. Sometimes it actually happens that I'm on the BCC list or the 2 list of like every firm in the country saying that we are looking for 5 crores of funding proposal. Please let us know if you are interested in investing, right? You know what happens in the next 10 minutes. Select and delete, right? Nobody reads anything post that. Second thing is that, you also have to, you will realize that inside a same firm, there will be different partners who will take different stakes on the, on a very similar investment proposal. So there might be somebody who says, you know what, hey, B2C is brilliant. Whereas, I know that Shekhar likes B2B businesses. Yeah. I like B2B businesses too. But there are, partly because B2C in India scares me. I don't know. But there are a ton of people who would gladly go after a B2C market, right? So a Mahesh Murthy might actually be quite okay with the B2C, right? There are a couple of people who are very boldly going after that, knowing whom you're writing to in that firm. It's not a firm having that stance, it's actually an individual. So write to that person and then have a meeting with them. It makes a lot of sense. First meeting makes a lot of difference. It's kind of a little bit like dating. If you show up there and basically say, hey, where do we go and all those things, it's not really going to go anywhere, right? The first meeting you have to impress saying that, hey, I am here, this is the business that I'm running. I know something far better than what you understand about this market, right? Floor them in the first meeting. Second day, my personal understanding is that they'll put all their associates on the job, that they will actually ramp up way more market research than you do, right? But that's okay. By then, it's actually equal footing by then, right? So all the numbers that he's talking about, hey, it's an $8 billion market and all those things, they will back you and they will even verify some of that numbers for you. But first meeting, you have to go with your numbers. If you go there and basically say, I'm going to organize the auto market, I don't even know how much money is moving through your slide.
The key kind of test there for us, at least within Axel, is when I know more about your business than you do, chances of me funding is very low. That's my rule. You have to know more about your business than me, which means more homework. Most people show up, take an auto example. Yeah. I say, how many autos you have spoken? I know I've traveled a lot on auto. I don't think I've spoken to any driver. How do I, get to the next level? 100 autos. Then I say, we want to do global. I've said, I've spoken to autos in Chennai, Bangalore, Mumbai, on the phone. If they're not even done those homeworks, that all shows us the gaps in their understanding or a conviction they have. We need to see that conviction. Conviction comes from the homework. If the homework is not there, it easily reflects.
So you also realize business goes through stages, right? Yeah. So I might be interested in taking on a person, on the idea on the person and the capability of that person, right? When it comes to a VC round, they're looking at it plain and simple, right? They invest in businesses. Ideas, people, whatever, it's all great. But unless all of this comes together to form a business, a VC firm is not going to look at it.
And exit.
Yeah, a PE is going to look at it from a perspective of, is this company have processes? Because now you need to scale, right? So important to do these things. So a lot of people get very, very offended when I basically tell them that, hey, we got this many applications, but, these are the 3 companies that we're talking to. It has nothing to do with whether your business is great or not. It is not like, pass or fail at all. It is, everything is relative, right? So there are peaks in a year where you basically say, usually I was not joking when I said April, May is when we actually see a lot of applications, because people actually get pissed off at work because of the appraisals and say, I'm going to quit and start my company, right? So we see a high peak during the post-appraisal season. So during that time, if you're basically sending in proposals to him, well, you cannot send ideas and pitches to him, but if you're sending into an accelerator, for example, they're going to look at it from perspective of, we have 150, we can only have slots for 50, versus a dry period when, you're probably the only deal on the table, which is like great for you, because VCs are going to spend more time with you. They have all the incentive to put the money to work, because they also have to return the money back.
Yeah, that is the truth. Is at the end of the day, we have to invest. We can't just sit not investing. If you're the only company, we have to invest.
Do not do anything drastic. Well, for businesses, it might be very different.
Yeah. Okay.
We'll get the data out of it. So yeah, think about it. Think about common advice that people say is that if you want money, go ask for advice. If you want advice, go ask for money, right? Almost every time you go and sit with an investor and basically say I want money, they'll basically say here are 20 things, and they'll do follow-up meetings and all, but they'll not give you money. They will do everything apart from that. So sometimes it's good to. My philosophy is that it's good to take money from friends, right? And I don't mean friends as in like, hey, from friends around. Have a couple of VC firms who are actually friends with you, because that communications that needs to be like, some of the things that happens in companies and some of the companies that we're close to, when things go badly, people start hiding stuff, right? I don't want to talk about the fact that, my next quarter results are not doing so well. The earlier you talk, it's great, but I will gladly do that with a friend. I would not do that with a VC firm whose incentives are obviously like, hey, is the company doing well, right? So it's important to have a relationship also, so that you can do that.
Good. So I think the last one is very critical, because people are short-sighted many times saying, I want the money.
There is no divorce in this marriage.
Yeah, basically, you are stuck, and I'm going to ask every quarter, every investor is going to ask, what's the revenue? What's the revenue? So it's just, tune you out. So you want to have a friendly VC. Yeah. Good. So that's what I had. Both of us discussed a lot. I thought it would be useful. Quick comments. Did it hit any information? Did you get enough information that you believe was useful? Thank you. Okay. We have quite a lot of friends here. Subbu from Bessemer. Bessemer, any comment? Subbu? Okay. Any disagreement with this? Okay. Because we didn't talk a lot of VCs. We kind of talked ourselves and said, let's do it. I am, new in the business. He is in the accelerator. If somebody hits us, we didn't know what we're talking about. Cool. Yeah.
In terms of a distinction that I see, the Indian founders think the problem that they're solving is, I'll do this, I'll do this also. Oh, by the way, I'll do this also. By the way, I'll do the fourth thing also.
Yeah.
So focus. Focus. So how do you bring focus?
You have a huge board which says VCs love portfolios. Entrepreneurs focus on one.
Yeah. So, I think focus is extremely important. If we even see that, which means the conviction is not there on the one idea, it's not a big enough. If it's a portfolio approach, it's very, very hard to build a sizable business. So you have to have one idea that you can put all your heart.
But the tag
to that, a de facto leader.
But the tag to that is that if you break through that 20 million mark, then you will not care about this.
Because you will not care about it.
Like, because if you look at Zoho,
$10 million plus, you will start seeing adjacency market. Your product starts moving left and right, or introducing new products for the same customer base. Very quickly you become a more dominating place. No big company has done with one product today, right? So, but there is always an anchor product, gets a lot of customers, then upsells with various sub-products.
So if Google can become Google with one product, anybody can, right?
Hi, I'm Sanjay Shukla. I'm trying to build a company in the higher education sector, specifically for engineering students. One of the challenge which I face is getting the market data kind of thing. I went to AICT website, I got their annual report, we got 200 page. There are halls in that.
The gentleman called Anand Daniel in our office, so that I think some of the other VC firms have invested. You should talk to him. He has got a lot of data on higher education. Only Anand Daniel.
Anand Daniel. Okay.
Look it up and he will tell you the data. And quite a lot of data is there. I think maybe that's the other thing we should do is, whatever homework we do, is start bringing out that data out in the public so that people get value out of it.
Guys, this will be the last question. Vijay as well as Shekhar are going to be around after the session. You can talk to them. You can catch up them in the hall. They're going to be around for the whole day.
Okay. Since it's the last question, I'll make it 2 questions. Number one, see, if I look up a VC firm, like you said, right person is very important, right firm is very important. There are already similar companies like mine in their portfolio. Right? Is it a good idea targeting them? Because
at least the firm by firm. In our firm, at least, we rarely want to invest in competing companies.
Okay.
Because competing companies means you're taking two different bets, and it's almost impossible to stop the follow-up of information.
Okay.
So it's not the right way.
But maybe if it is a geographical split, North India, South India, something like that.
No, but the thing is, when you look at the potential of 5 years from now, is there even a 1% chance they will enter North India? Will not touch it.
Okay. Good. Okay. Second question. Okay, whenever I look at VC investment against, let's say, a strategic investment or strategic acquisition, right? I always feel that VCs are jack of all trades, master of none. So they don't know your business, but they keep asking for revenue, etc., etc. Whereas a strategic investor is someone who will understand what is the market, what is the customer better, who is the customer better, and help me solve a couple of pain points which I have. Right? So how do you make these choices even? Because I don't get good valuations. I don't get good valuations when it is strategic investor.
If you believe you get to a $20 million plus revenue without, I wouldn't go in strategic route. Strategic route means there's no exit potential other than that. Your all other options, no other buyer will come and buy you until you sold. It's just like already half marriage done with the strategy. Okay. If they decide not to buy you, you are in trouble. So that's the reason. But if it is an okay outcome, you can get 5 crores, somehow go and do it, man. So just get the money, because I want to come and solve a bigger problem in the next round.
So first question, I would basically say that if there is a VC fund, for example, and they have a very large company which is in their portfolio, they're not active members anymore, but it's in the US, and you have a very similar company in India, it still might make sense to talk to them, because entering different geographies has always been complicated. So if
I'm saying US versus India different. I'm saying India only.
If you prove that market in India, for example, Uber versus Ola cabs or taxi for sure, whatever it is, right? So it's not a bad idea to go talk to the people who ran Uber and invested in the US, right? Because eventually when Uber is trying to get into India, they might actually be interested in acquiring. So there might be some synergies there. Second thing, it is not always a great idea to have an investor who knows really too much about your business also. Because at some point they'll come in and basically say, this is all wrong, this is how you should do. They'll get too operational, right? As an entrepreneur, and I am an entrepreneur, right? So I'm always siding this side. It is important to know that, we can lean on somebody when you need help, but at the same time, it's also important to say that, hey, there is this line where this is operational, I will report to the board as required.
Okay. So most of the VCs give you functional help, not the domain help. The domain help has to come from the team. The functional help about recruitment, scale, funding, who is the follow-on investor, which market to go, those kind of help is where you can rely.
So this whole thing about VCs taking over companies is a myth. Yeah. They don't.
Okay. One last question again.
I think we can take it offline. They're going to be around.
Thank you very much.
Thank you. Thank you for your time.
Thank you very much. Guys, give your feedback. It will be great if we